Good evening, ladies and gentlemen. Thanks for joining us tonight for Investor Forum. Today, we have with us Mr. Loh Wan Chen, Vice President, SIAS and CEO, Asia Pacific for Black Sun, to share with us on ESG and sustainability. What should investors look out for? Followed by a panel discussion. Should you have any questions you would like to ask the panel of experts, you may post your questions using the Q&A function at the bottom of your screen. We will endeavor to answer your questions if time permits. Without further ado, I would like to welcome our speaker and moderator, Mr. Loh Wan Chen. Over to you, Mr. Loh.
Thanks so much, Christine, and good evening, everybody. I know all of you are hungry, but let's start the session by asking, what do investors want? And the answer is, show me the money. Some of you may have watched this movie before. It's from Jerry Maguire. The most famous quote from Tom Cruise, show me the money. And that's really the starting point of today's session. What I hope to do today is really to start you from a big picture in terms of what's important to investors, and then how do we drill down to very specific items like what is ESG, what is sustainability reporting, and then how does that figure into helping you to make more money and not to worry about what are the technicalities with regards to what is ESG and what is sustainability reporting. We'll be going through a lot of the issues, a lot of the challenges. We try to demystify some of the terminology and of course, answer some of your hot questions that you may have for this evening. So in addition to the panelists, I hope that by the end of today's session, most of your hot questions are being answered. So the big picture that we have this evening is really whether we talk about ESG or sustainability reporting, financial reporting, corporate reporting, annual reporting, the big picture focus for investors is really show me the money. Whatever we do, if it doesn't result in more money or at least in some fair decent amount of money, then it doesn't make sense for investors. Of course, not losing money is just as important, but how do you make sure that whatever we do adds to the contribution to the investors? And that's really the challenge that we have today. How do we open up your eyes to the opportunities that ESG and sustainability reporting pose for investors? And then how do you look out for those opportunities as you move forward? The world has changed significantly, and really we need to open your eyes beyond looking at what we call the mission, the strategy and vision. So if you look at the big picture, that's why we started by saying that we show the money. And if you smell the money, a lot of investors typically go towards three things: the mission, the vision, and the strategy. The what do you do, how do you do it, and where do you go from here? And typically that's where the vision of investors are focused on in terms of showing me the money. And very largely so, if you look at the yellow highlighted portion, is really the strategy. So if you look at a lot of annual reports, when the CEOs, the chairman, they talk about strategy as how to make money. And that's where it's very focused for a lot of investors currently and also in the past. But like I said, the world has changed into a lot of things which are called non-financial indicators, things that don't tell you exactly what it is, but you only know later down the road. Like for example, culture. We all know that culture is very important, but how does culture fit into this this diagram here, which I call a targeting diagram? So as you target towards showing me the money or showing you the money, you focus on strategy. That's a very targeted approach for investors. But when we talk about culture, how do you target culture? How do you focus on something that's difficult to count, like culture? And then how does culture add to making more money for the investors? So from a big picture perspective, showing the money, looking at very specific that investors have today, which is very strategic focus. When you bring in factors like culture, climate change, gender diversity, how do all these items, or what we call, soon I'll introduce them, these are called ESG factors. How do these ESG factors fit into that big picture that you have in showing you the money? So always going back to the big picture, showing the money. And like I say, when you go now into a bit more focus, the current focus is on strategy. And most investors are familiar with that focus, that they help you to look at their investments and the portfolio. But occasionally, we have this thing called culture is strategy for breakfast. And you've probably heard of this term before by Peter Drucker. The quote, the culture is strategy for breakfast. But what does it really mean when we say culture is strategy for breakfast? And the next slide shows what it means, that when culture goes wrong, Look at situations like Volkswagen, Uber, Nissan, Wells Fargo, and Samsung. A lot of these situations when the culture goes wrong, it costs investors money. You look at Wells Fargo, $3 billion of fines. Samsung, they lost the entire Galaxy Note 7 because of a culture, a top-down culture that was too militaristic. So a lot of things have gone wrong as a result of culture. Now, when strategy goes wrong, it's easy to understand because strategy is a bit more understandable for most investors. But when culture goes wrong, or even before culture goes wrong, how do we know that there's a bad culture? How do we know there's a good culture? How do we know that good culture can lead to bad culture and can lead to situations like Wells Fargo, Volkswagen, or Nissan, or Samsung? So that's really the challenge. How do you open up the investors' eyes to seeing something like culture, gender diversity, and things like climate change? How do all these new things have come upon us? How do they affect the big picture, like showing me the money? So once again, going back to the big picture, showing me the money, investors are very focused on strategy, but strategy gets eaten up by culture, and culture costs investors money. So how do you manage this thing called culture? How do you count culture? And we've seen that culture costs investors money. So it's important to investors to not just look at strategy, but to start looking at things that are difficult to count, like culture. And as you can see, the regulations around the world, in Malaysia, in Singapore, in the UK, culture is becoming very important because of all this bad culture has led to organizational failures and big scandals around the world. So you start from Malaysia on the left, they look at last June 2020, the MACC Act, the need to emphasize the cultural integrity. The Code of Corporate Governance in Malaysia requires the companies to have a culture of accountability and transparency. Singapore Code of Corporate Governance, that companies should have an appropriate culture of linked to good values and ethical standards. If you look at the UK, it's even more interesting. They say that they must have a clear purpose. What is your why? Linked to a healthy corporate culture. So we look at all the descriptors: appropriate culture, healthy culture, cultural integrity. And finally, if you look at the bottom part here on the right-hand side, in the UK, since 2020, if I'm not wrong, beginning of last year, the UK code requires companies to disclose and report on their culture in their annual report. And it is the board's responsibility to sign off on that. So without a doubt, if you look at what has gone wrong in terms of culture or bad culture, if you look at regulations around the world, culture is very important. But what is this thing called culture? And how does it compare to strategy? So investors, if you look at, once again, the big picture and focusing on where is the money, show me the money, and they're able to zoom in on strategy. So every time investors goes for road shows, investors briefing, talking to the CEO and talking to CFOs, it's very common to investors to ask, what is your strategy? But how often do you ask, what is your culture? And not only asking what is your culture, but how does your culture affect the bottom line of the organization? Of course, we know that bad culture leads to the organization losing money. We've seen that with Wells Fargo, $3 billion. But how does good culture lead to the company making more money that's in the interest of investors? And how do you prove that good culture can lead to the company making more money? What are some of the indicators that tell you that the company is on the way to or has a good culture and that you will invest in a company with good culture? How does the company tell you that it has a good culture, apart from saying that I got good culture? No, it's so simple to say that I got a good culture, but yet when things go wrong, people say what went wrong. But when you look at strategy and you focus on the wrong products, it's very clear, very apparent that you focus on the wrong product, at least from a hindsight point of view, of course. But typically, at least you have something tangible to look at. You focus on the wrong product or wrong market, is something a bit more tangible to focus on. But when it comes to things like culture, diversity, climate change, how do you prove? How does the company prove to you that all these things can lead to the company to make more money for you as the investor? So the challenge for this evening is really, how do you count culture? How do you count climate change? How do you count gender diversity? How do you count the things that are not countable? So you have this famous quote from Albert Einstein, well, attributed to him. He says that not everything that counts can be counted. So culture counts, but it's very difficult to count culture, and not everything that can be counted counts. So that's a very important quote, but also it's very challenging. How do you count culture? And this is where the start of the journey is really, the journey of sustainability reporting is really looking at things that are difficult to count. And let me show you this diagram here. So take a few seconds to focus on this diagram here, because this is the start of that opening up your eyes in terms of the world of sustainability and ESG. If you look at the earlier diagram, as you remember, the investors' eyes are very focused on the word strategy. So if we look at showing the money as a big picture, investors zoom in on asking the question strategy. But what I would like to do now is open up your minds and not just ask strategy, but ask what is the ESG factors in the organization. So ESG factors are things that affects the company's performance. And this from the SGX listing practice note 7.6. So ESG factors are things which are important to the company's performance and prospects, meaning that can they make money, will they lose money, will they perform well, will they not perform well? So these are examples of ESG factors. Different countries use different terms. Some call it ESG issues, some call it ESG risks, but they're all the same. Essentially, they are things that affect the company's performance. And generally, these are the things that are difficult to count, difficult to measure, as opposed to something a bit more tangible, like, for example, strategy, product, market share. These are a bit more tangible things and something that over time investors has gotten used to. So take, for example, the AGM session season is coming up soon. April is coming up soon. In Malaysia, it's May coming up soon. So when you go to AGM, a very commonly asked question is that, Mr. Chairman, Board of Directors, what is your strategy post-COVID? What's the strategy in 2022? How do you make sure that you make money in 2022 and moving forward? What's the strategy for working from home? So the word strategy is very common and commonly asked in AGMs, in board meetings. But how often do investors go to an AGM and ask, have you considered all the ESG factors? Have you considered all these issues that affects the performance of the company? So that's one takeaway that I would like all investors to take note of in this AGM session coming up soon, is to ask what is the ESG factors that affects the company. In fact, the first question that you need to ask is, how do you manage the culture in your organization so that things like Samsung, Wells Fargo, Volkswagen, all these are the things that don't go wrong for the organization that you invest in. And believe you me, culture is a very important thing right now. Otherwise, you wouldn't have all these regulations that's coming up all around the world, trying to manage and regulate culture in companies. So even in the US, the 10K filing, they require disclosure on culture, on human resources. So culture is here to stay, and it's becoming a very, very important factor to consider. So whether you call it ESG factor, ESG risk, ESG issue, it's what we call something that affects the organization. And the other things that's hot in today's environment, of course, climate change, diversity, pandemic, regulations, technology. And the pandemic is there because it's front and center in front of all of us. So because it's front and center, it's right in front of our face, we tend to ask the situation. So I'm sure at every AGM in this coming season, everybody will ask, what are you doing about pandemic? And seldom will people ask things like culture, for example, because it's far from the mind. So when things are far from your mind, you tend not to ask it until something goes wrong. So for investors, you should ask for things that before it goes wrong, you start to ask for it. So please do ask about culture. And when answer comes, we got a good culture, then you should challenge that. How do you know that you got a good culture? How do you measure culture within the organization? So as part of sustainability reporting, it's about measuring, which I'll come to in a little while. So if you look at this diagram here on the right-hand side of your screen here, ESG factors are issues that affect the company. Where do ESG factors come from? It comes from stakeholders. So example of stakeholders will be yourself, investors, employees, suppliers, regulators. It could be the community. It could be your consumers, could be your customers. So things of people that are important to an organization, from these people, ESG factors will arise. So ESG factors are things which are important to your stakeholders. And later on, if I'll talk about the importance of stakeholder engagement, if you notice in the Singapore Code of Corporate Governance, Principle 13, there's a new section in there that was in the last updated code. It talks about stakeholder engagement. So ESG factors come from stakeholders. And if you don't manage ESG factors well, there'll be risks. If you manage it well, there'll be opportunities. So remember this targeting. So when you ask questions at AGM, first of all, ask the question, how do you manage culture? So you as a shareholder, you're a stakeholder. And you ask about culture because culture is important to you, because if the organization has a bad culture, it potentially can lead to losses for you as an investor when the company collapses like Samsung or Volkswagen or due to a scandal. So if it's important to you, then the company must manage the ESG factor. So culture needs to be managed. If they manage it well, there's an opportunity for the organization to grow. When the organization grows, it makes more money for you as an investor, as a stakeholder. If you don't manage culture, things go wrong, the company loses money, it's bad news for you. It can't show you the money. So this is how you read this diagram here. So the starting point is really, who are your stakeholders? What's important to them, which is the ESG factor. So today, the takeaway point is keep on asking culture. So, and why is it important? Well, because things can go very wrong if you have a bad culture, and regulations around the world has shown that culture is a very important factor. And it's called an ESG factor, very important factor to make sure that companies don't go wrong. And not only don't go wrong, but you manage it well, you go right for you as an investor, for a shareholder, as a stakeholder. If you remember the Code of Corporate Governance in the UK, they highlighted the word purpose. So purpose drives the culture of the organization. So purpose is why do you do what you do? And typically there are 5 reasons why you do what you do, and they focus on your customers, employees, suppliers, community, and your shareholders. For each one of these stakeholders, you give rise to the ESG factors. So customers are important to you, employees are important to you, suppliers are important to you, communities are important to you, and shareholders, of course, is important to you as a company. And all these people here are stakeholders. If you engage with the right stakeholders, and the people who are important to you, you come up with the list of ESG factors. And one of course is culture. Once again, I repeat, culture is one key factor that will come up again and again, notwithstanding who your stakeholders are. And once again, as I reminded you, Principle 13 of the Singapore Code of Corporate Governance requires the companies to look at how they engage with the stakeholders in order to drive the performance of the organization. So these are the minimum 5 stakeholder groups in companies. Of course, there are more. Government regulations, students, for example. These are, for example, depending on different industry, these will be potential stakeholders. So coming back to the big picture again, your focus at the big picture is show me the money. As you drill down, you've been used to focusing on strategy and how do you use strategy to drive the performance of the company to show you the money. But what I'm saying is that there's a parallel universe out there called ESG factors that are parallel to strategy, and ESG factors can affect the company just as much as strategy. And one important ESG factor is culture. And when culture is not managed well, a lot of things can go wrong. But you manage it well, culture, when it goes right, there's a lot of upside to you as an investor, as a shareholder. Where does ESG factor come from? ESG factor come from stakeholders, and stakeholders are people that's important to the organization. And if ESG factors are managed well, there's upside, it shows you the money. So imagine a situation where if strategy is managed well, ESG factors are managed well, you have a twin target, and if you have twin targets are hit, technically you have shown you more money for the organization. So that's really the gist of it. Is that when you start from a big picture and you do down, you realize how important ESG factor is, because technically it should help you to make more money for the for you as an investor, for you as a shareholder. And from a disclosure point of view, this is the listing rule 711A and 711B. So SGX requires an issuer or list code to issue a sustainability report 5 months after year end. So what does it mean when you read a sustainability report? So remember I mentioned when you go to the AGM, the first question that you ask is that, Mr. Chairman, members on the board, directors, how do you manage culture in your organization? And that's answering the first question. What are your material ESG factors? Material means important ESG factors. And the one factor that I say will exist for all organizations, for all industry is culture. And culture can be deadly, as we've seen, but culture has an upside. You've seen companies with good culture, they perform well, means good returns for organization. Companies that don't manage culture will lead to potentially a cost to them for investors in terms of scandals, in terms of losses. So when you read a sustainability report, the first thing that you need to do is to look out for how the company identify ESG factors. A lot of companies don't identify it well, some identify it well. So you need to ask the question is, how do you identify the ESG factor, and how come culture is not in there if it's not? The rest of the other items here in the sustainability report that's required to be disclosed. So you must have policies, procedures, practices, performance. How do you manage sustainability with an organization? It's relatively easy. What are your targets? So your target, for example, is good culture. So culture is an important factor, and your target is good culture. Or in the Code of Corporate Governance, some of them call it appropriate culture. Some would call it a good culture, but notwithstanding how you describe culture, it is still a target. You can't just say, I need to have a culture. It doesn't make sense. So when you disclose culture as an ESG factor, you should ask, how do you target for an appropriate culture? And what do you mean by appropriate culture? So targets are very important. Otherwise, if it's not measured, it won't be managed. So you need to measure culture. And once again, remember we say culture is so difficult to manage because it's very difficult to count. But notwithstanding, even if it's difficult to count, we know that when it goes wrong, this leads to a lot of cost for the organization and for investors. So this is the beauty of sustainability report. It's important, but at the same time, it's difficult to manage because it's all the what we call intangible factors. So ESG factors are intangible, and next strategy. So product strategy, market strategy is more tangible. Growth strategy in terms of number of people, headcount is more tangible. But how do you grow using culture? So these are the 5 items that need to be disclosed in the sustainability report, but it all starts with the ESG factor. So if you talk about culture, then you talk about how do you have policies and procedures and performance managing culture? How do you have culture targets? How do you report culture? And how does the board say that culture have been managed well within the organization? So my lesson that I'd like to impart to you is that when you focus on culture, ask on culture, when you look at the sustainability report, just ask that question. How do you manage culture and describe culture within your sustainability report? How do you set targets? And let's see how the board and chairman respond to that, because it is in your interest to ask that question because there's upside for you as a stakeholder, as an investor, as a shareholder. So here you add in on, if you look at the right-hand side, traditionally investors can be focused on the what, the how, and the where, the strategy. And then on the left-hand side, there's something new, relatively new in terms of reporting, reporting requirements of sustainability reporting. It's only not so long ago, 3-4 years ago in Singapore, and even around the world. So how do you focus on these twin targets where you focus on strategy, not forgetting about what you do in terms of your products, in terms of your go-to-market, in terms of which sector you focus on, in terms of your geography focus. So the blue part is something that investors are familiar with. It's a left side that is more the intangible, the ESG factors, the culture, the climate change, the gender diversity. So you believe that all these factors can lead to the upside and you manage it well, the opportunities, and you've spoken to the right stakeholders. So if you engage with the right stakeholders under Principle 13, you've identified the right risk, the right ESG factors like culture or diversity, you manage the upside, there's opportunities. If you don't manage it, risk will crop up, things can go wrong. So risks appear in both sides. You don't manage your ESG factors, risk comes out here. You don't manage your strategy well, risk comes out here. So there's twin target. If you hit the target right, technically you can make more money for the organization. Otherwise, why bother to manage culture? If culture don't have upside, my question then is that, why bother doing it? So as investors, you must be able to see the upside. And the reason why I can see the upside is because it's the issue that's important to you as a stakeholder. So when you go to attend the AGM, go to the AGM asking the things which are important to you as a stakeholder. So it may not be culture, it could be other things like, for example, diversity, it could be climate change, could be technology, it could be AI, it could be anything under the sun. But these are what we call ESG factors. There's no end to what we can call ESG factors, but typically you focus on what's important. So how does the company identify important ESG factors so that they can manage it, so that there's upside for you as a stakeholder? So what are the challenges? It's a very confusing field out there. So there are many standards for the report on sustainability within for organizations. I won't go through all these details here, but suffice to say, it is a very crowded field. And this crowded field has led to what we call a lot of use of boilerplates. So this is a typical statement that you see in sustainability report. So this is what we call a typical board statement. And the board statement makes use of a lot of these acronyms that you see here. So that is really the challenge. There's a lot of science to it, unfortunately, and science that is very difficult to understand for the man in the street. Even for me, it's very difficult to understand. You read this board statement, how does it show you that the organization is making more money? By the time you read, I don't know how many words these are, by the time you read from the start and finish at the end, you need to have one conclusion. Is the organization making more money? Otherwise, what is the statement purpose for? So the statement of this sustainability statement that the board makes must lead to the organization making more money or managing the risk so that things don't go wrong for the organization. And the third thing that is really the challenge is there's a lot of greenwashing. Greenwashing means that making people believe that the company is doing more to protect the environment than it really is. So it's a lot of show and tell, but no substance to it. So things like planting a tree or once a year, painting a house once a year, helping an old folks home once a year, that's not sustainability, that's not managing ESG. So if you look at SGX guidance, ESG is not philanthropy or other charitable activities. So it must be strategic. So these are the three common challenges for sustainability reporting or ESG factors management. So my last three slides before we go to the panel. What should investors look out for? Principle 13, investors must look out for how the company is engaging with stakeholders in the organization or for the organization. Because remember, it is through engaging with stakeholders, that you're able to identify the ESG factors. It is through engaging with stakeholders that you can identify the ESG factors. So how do you know that culture is important for this organization? So if you go to an AGM and you ask the question, Mr. Chairman, where is culture? The chairman should be able to answer to you and say that culture is not there because we've engaged with all stakeholders, and nobody has mentioned that culture is an important issue. Nobody has mentioned that culture is an important ESG factor. And that's okay. But if you don't engage with all the stakeholders that are relevant to the organization, how do you know that culture is or is not important? So stakeholder engagement is the start of it all. And a lot of companies don't engage with stakeholders well. It's a very template, boilerplate disclosure in the sustainability report. So the next time you attend the AGM, ask the company, how do you engage with your stakeholders? So remember, there are generally 5 groups of stakeholders: your customers, your employees, your suppliers, your community, and your investors or shareholders. So typically, there are 5 groups of stakeholders that the company must engage with. And through this engagement, you can identify what are the ESG factors. And like I said, there are many ESG factors out there. Could be climate change, could be culture. So once again, I keep on repeating this because you need to get into your head that don't just ask strategy. So strategy is one part of the target. The other twin target that you need to focus on is ESG factors, because through managing ESG factors, you can manage the risk, manage the upside, and essentially show you more money from the investor point of view. It's a very confusing field out there. So there are many standards for the report on sustainability within for organizations. I won't go through all these details here, but suffice to say, it is a very crowded field. And this crowded field has led to what we call a lot of use of boilerplates. So this is a typical statement that you see in sustainability report. So this is what we call a typical board statement. And the board statement makes use of a lot of these acronyms that you see here. So that is really the challenge. There's a lot of science to it, unfortunately, and science that is very difficult to understand for the man in the street. Even for me, it's very difficult to understand. You read this board statement, how does it show you that the organization is making more money? By the time you read, I don't know how many words these are, by the time you read from the start and finish at the end, you need to have one conclusion. Is the organization making more money? Otherwise, what is the statement purpose for? So the statement of this sustainability statement that the board makes must lead to the organization making more money or managing the risk so that things don't go wrong for the organization. And the third thing that is really the challenge is there's a lot of greenwashing. Greenwashing means that making people believe that the company is doing more to protect the environment than it really is. So it's a lot of show and tell, but no substance to it. So things like planting a tree or once a year, painting a house once a year, helping an old folks home once a year, that's not sustainability, that's not managing ESG. So if you look at SGX guidance, ESG is not philanthropy or other charitable activities. So it must be strategic. So these are the three common challenges for sustainability reporting or ESG factors management. So my last 3 slides before we go to the panel. What should investors look out for? Principle 13, investors must look out for how the company is engaging with stakeholders in the organization or for the organization. Because remember, it is through engaging with stakeholders, that you're able to identify the ESG factors. It is through engaging with stakeholders that you can identify the ESG factors. So how do you know that culture is important for this organization? So if you go to an AGM and you ask the question, Mr. Chairman, where is culture? The chairman should be able to answer to you and say that culture is not there because we've engaged with all stakeholders, and nobody has mentioned that culture is an important issue. Nobody has mentioned that culture is an important ESG factor. And that's okay. But if you don't engage with all the stakeholders that are relevant to the organization, how do you know that culture is or is not important? So stakeholder engagement is the start of it all. And a lot of companies don't engage with stakeholders well. It's a very template, boilerplate disclosure in the sustainability report. So the next time you attend an AGM, ask the company, how do you engage with your stakeholders? So remember, there are generally 5 groups of stakeholders: your customers, your employees, your suppliers, your community, and your investors or shareholders. So typically, there are 5 groups of stakeholders that the company must engage with. And through this engagement, you can identify what are the ESG factors. And like I said, there are many, many ESG factors out there. Could be climate change, could be culture. So once again, I keep on repeating this because you need to get into your head that don't just ask strategy. So strategy is one part of the target. The other twin target that you need to focus on is ESG factors, because through managing ESG factors, you can manage the risk, manage the upside, and essentially show you more money from the investor point of view. The second thing that investors need to look at is really the support integrated thinking. The integrated thinking meaning that how do you look at both strategy and sustainability or ESG factors? So looking at both profitability and value creation. So if you have a good culture and culture is managed, is an important ESG factor, you create value for the organization. And value, when it's created, will lead to more profits for the organization in the long term. But at the same time, money will be made, so profitability still must be there. So sustainability reporting is not an and or, it's both, it's and. So it's talk about managing ESG factors and making money for the organization. Managing ESG factors and strategy for the organization. So having that twin focus is important. So when you look at the annual report for the organization, when you ask the board questions, you would ask questions like, how do you manage ESG factors and profitability for the organization? How do you focus on building culture, which is a long-term focus, and making money for the organization, which is a mid-term to short-term focus? It's a quarterly target. So quarterly reporting, half-yearly reporting, annual reporting, these are very short-term mid-term focus on making money for the organization. And it's important to make money, because if you don't make money in the long term, we all did anyway. So making money is important, but at the same time, long-term issues like culture is important. So it's a twin target. So remember, it's a twin target. And finally, the last thing that I want to focus on is, this is from the Code of Corporate Governance, that the remuneration of the board and management are linked to value creation and the strategy of the organization. And increasingly, there's a lot of companies with the disclose in annual reports that the remuneration, some will be 20%, some could be 30%, but a significant amount of the remuneration is linked to long-term value creation. And this is recommended in the Singapore Code of Corporate Governance, as you see here. This is quite adopted around the world. So this is a third recommendation. So first one is make sure that you focus on stakeholders, Principle 13 for Singapore Code. Secondly, integrated thinking from the organization, management from the board point of view, focusing on both profits and ESG factors, so both short-term and long-term perspective and value creation. And thirdly, what gets measured gets managed. So ask the question, how do you encourage, how do you motivate, how do you drive behavior? Because managing, if I don't manage culture, if I still get paid the same amount of money, then why bother to manage culture? Let culture take care of yourself down the road. If culture goes bad, it's not my problem if I'm not remunerated for managing good culture. So that's important to look at both short-term remuneration, revenue targets, and long-term remuneration, which is things like ESG factors, things like culture. So with that, I've come to my short presentation. So let me summarize before I introduce our real eminent panelists here. So we start with the big picture. The investors always ask, no matter what, show me the money. Otherwise, why are you an investor? So you're an investor because you want people to show you the money. You want organizations to show the money. And traditionally, showing the money has been focused on strategy. How do you make money? And where do you make money? And what do you do? The what, the how, and the why. The purpose, of course, is a bit more further out there. But strategy is a key focus for typical investors out there in the marketplace. When you go to AGM, you ask the board and the chairman, what is strategy post-COVID? What's the strategy for 2022? And how come you perform like that in 2021? Why did strategy go wrong? So what I've introduced you today is a twin focus. One is on strategy and one is on ESG factor. And ESG factors come from stakeholders. And one very important ESG factor that I focus on today is culture. Why is culture important? Because if you don't manage it, things can go very wrong. It will cost you a lot as investors. Less to distribute and less to go around for investors. And how do you know that culture is important? Not just things that go wrong, but a lot of regulations and governance code focusing on culture. So without a doubt, culture must be asked at AGM. Otherwise, it won't be in the code and regulations around the world. So twin target of ESG factor, one of which is culture, focusing on strategy, coming together, what we call integrated thinking, and looking at both short-term focus on profitability and strategy, and long-term focus on the intangibles like culture, climate change, gender diversity, technology, and things that have a long-term impact on the organization. So focusing on both long-term and short-term, driving behavior well through the appropriate remuneration, and driving them to meet targets which are both short-term and long-term, will make sure that the investors, the shareholders, and the stakeholders are appropriately rewarded from the investment point of view. So with that, let me introduce our eminent panelists. And first and foremost, we have Eliza Tan, Ms. Eliza Tan from Singapore Exchange. She's the Vice President from Listing and Compliance from SGX Reg Co. Welcome, Eliza.
Good evening, everyone.
Evening, Eliza. Second panelist, we have Professor Lawrence Loh, Director for the Center of Governance and Sustainability from NUS Business School. Thanks, Prof.
Hello, everybody.
And last but not least, we have Mr. Martin Lechner, Managing Partner of CoreCam Private Limited, which is a family business.
Good evening, everyone.
Evening, panelists. Thank you for your time. So what we'll do is that we have 3 key questions that we'll be asking the panelists to set the pace. And what we'll do is that then we'll take questions from the floor as we hear from the panelists once they set the pace. So with that as a background, what I presented, the first question that I would like to ask the panelists is like, sustainability reporting costs time, costs money. You need to engage with stakeholders. You need to identify ESG factors. You need to spend time and money coming up with a sustainability report 5 months after the annual report, 5 months after the year end. So there's effort. It's not cheap. And you're going to do it every year. How do you justify to investors that you need to invest in this cost? So maybe we can start with ladies first, then we go on to Lawrence, Prof. Low, and then we go to Martin. How do you justify sustainability reporting?
Right, thank you, Wan Chen, for the question. So sustainability report, right, how we view it is a very important communication tool that bridge the information gap between the company as well as the stakeholders. So as Wan Chen has mentioned earlier, stakeholders engagement is a starting point for the company to identify what are the material ESG risks and opportunities that the company is confronting with. So if we were to dissect sustainability, it's about assessment as well as management of ESG related risks and opportunities, adoptions of sustainable business practices, as well as future proofing your business. So all these have financial implications on the company. So let me just give an example as to how adopting sustainable business practices can bring in the money for investors. Increasingly, we are seeing a trend of companies using sustainable financing. So we see that companies have managed to secure sustainability-linked loans. And how these loans work is that they will feature interest rate discount that are linked to predetermined ESG performance targets. So when companies that has obtained such loans manage to meet these targets, the companies will be able to enjoy interest savings. So that is one good example as to how adopting sustainable business practices can bring in cost savings for the companies.
That's a very good point, Eliza, on green loans, green bond, green financing. So if I were an investor, should I insist that all your loans be green? Because, I mean, it's really straight to the bottom line. I mean, if I comply with all the KPIs that the banks require for giving me green loans and a better rate, it's straight to the bottom line for me, I mean, for an investor.
Depends on the type of loan. So for specific loans like green loans, it may be tied to certain property or certain projects that the company is undertaking. So currently what we see is that increasingly financial institutions are taking into consideration ESG performance in their lending decisions. So it becomes pertinent that companies take into consideration the ESG factors, how they manage these factors, and disclose it in their annual report or their standalone sustainability report in order to assess capital. So Wanchen, to answer your question, we are seeing increasing trend, but we haven't come to a stage where we see all the companies are just gearing towards or switching towards just green loans or sustainability linked loans. So there are still a combination of banking facilities that are used by our listed companies.
One more question for you, Eliza, before I go to Prof. Low. Do you see a day when banks, when they give out loans, they say, unless you are green, I won't give you any loan?
I think indications are that we are moving towards that directions because we hear about financial institutions excluding certain business segments from their lending decisions. For example, like those dirty industry like coal, some of the banks are staying away in terms of providing financing for such industries. So I don't discount that possibility since the general direction is that we are moving towards greener solutions as well as financing in terms of allocation of capital to influence the decisions of investors as well as companies.
Thanks, Eliza. I hope that one day that banks will say, show me that you got a good culture, otherwise I won't lend you money. Prof. Loh, coming to you, how do you justify sustainability reporting? You've done a lot of research on sustainability reporting. Recently, CGIO changed its name to include sustainable. So it is a very important topic, and a lot of resources, a lot of time I spent on it. Is it correlated to making more money for investors?
Yes, thank you, Wan Chen. First, I must thank you for the very informative presentation. Actually, we should be asking you questions, but never mind. Anyway, thanks for leading me to this. You're right. Actually, I myself has done quite a bit of research. So in addition to the specific example that Eliza has given, let me give you some indication from statistical studies that I have done in the Singapore Exchange. What we have done is to look at, among all the listed companies that have done sustainability reporting, we measure them in terms of, first of all, whether they do the reporting or not do. Secondly, we look at the quality of the reporting. In other words, our research center actually has a framework to measure the quality of the reporting. And lo and behold, what we have found, we try to correlate. We use actually some robust statistical techniques called regression, which is actually trying to see the relationship between sustainability reporting and market value of their stock here. What we have found is a positive and significant relationship, and these results are all published in academic papers. So I think at least beyond the specific example, at least from a large sample perspective, we also triangulate and support some of the indicative and intuitive best practices report of sustainability. So the short answer is yes, there is a relationship. I'll stop here for now.
Thanks, Prof. Loh. And does that translate to investor behavior? If investors read all the research, they will know that there is a correlation between sustainability reporting and better returns for investors. So are investors now rushing to invest in sustainable organization? Are they asking for more questions at EGM, like asking, how come we don't include culture? Why is the sustainability report so thin? Why are we not focused on why are they asking all these pertinent questions?
Yes, in fact, I'm maybe in the Singapore scene, is the level of maturity is not quite there yet. But in many of the more mature, more advanced equity markets, you can see many investors actually asking such questions. And mainly now, I think that the leader of the pack are usually the larger investors, the institutional investors. They are the one actually posing all the very critical questions. In fact, from what I see on the ground now many of the big investors going to the company, they actually don't talk to the CFO anymore. They talk to the Chief Sustainability Officer first and foremost. So yeah.
Thanks, Prof. So you're saying that the big institutional investors are asking that. So people like BlackRock who ask some of these hot topics. But why isn't the retail investors, how come they are not asking these questions?
I think basically it is also in indication of probably the incentive and motivation. And I think perhaps by the forum today, I think SIAS is basically doing a very good job in igniting the interest of retail investors as well. First of all, I think it's to bridge the gap of awareness, bridge the gap of trying to know what the new direction is. But having said that, I think you can't go wrong if all the big investors are moving in that direction. As individual retail investors, small investors, all you need to do is to follow the bandwagon. I mean, you can't go wrong.
Okay, thanks, Prof. Loh. Martin, over to you. You are a family office. You do a lot of investments. How do you look out for companies in terms of sustainability reporting? And when they do sustainability reporting, you ask, show me more money. Otherwise, why are they doing sustainability reporting?
Thank you. First of all, congratulations. I think you picked one of the most important topics out there. And what the investors have to realize is that there's a very high correlation, a positive correlation of companies being ESG conform, having a better performance than the ones who are not ESG compliant. And I think the investor at the end has the ultimate power. It's not the regulator, it's not the governments telling the companies, you have to be more sustainable. It's the investor, because the investor will only invest in shares, in themes, in ETFs, in stocks, in funds, if they are compliant. Because the investor learned in the last 2-3 years, with the massive inflows, the billions of assets under management from the institutional side, but as well recently from the retail side, going into ESG themes, that you had a big price performance in those stocks, and people made a lot of money with following the ESG theme. And I think that is the ultimate motivation and the ultimate pressure for the companies to be compliant, because they realize their competitor, who is more compliant, who has a more diversified board, who has a better kind of equalized compensation package, who is more ESG carbon neutral emphasized, that their stock price performance is better, that they attract more institutional and better institutional shareholders who follow the UN principles of responsible investing. And so I think it's a very healthy development we saw recently, that the investors are kind of putting the power, the pressure on the companies that they have to fulfill those sustainability measurements.
So there is indeed more money, show me more money, and it's coming through for investors who invest in ESG positive companies.
And especially after COVID, with the fiscal spending and the Green Deal initiatives in the US and in Europe, you had in the last 12-24 months, very positive price performances and very high positive correlations to companies who are ESG leaders. And the ESG laggers had the opposite.
So all three are very positive. All three panelists are saying that you can potentially, the company can show you more money through green financing, positive correlationship of share price, better returns by focusing on companies which are green, which are focusing on the ESG factors. So if I were retail investors, you can ask these three panelists, going back to Eliza and then Prof. Loh and Martin, if I were a retail investor and I go to AGM, what question would I ask with regards to ESG or sustainability? Just one question that will make sure that I ask the right question. How do I make sure that I ask the right question?
Yeah, I just also wanted to highlight to the investor here that SGX has issued an investor guide to reading sustainability reports. Contained in these investor guides, there are also a series of questions, like Wan Chen mentioned, to be posed to the board. So one of the important questions we thought issuers, retail investors can raise with the company is this: so what are the material ESG factors that are faced by your peers which are not considered to be important to the company? And why is that so?
Okay, thanks, Eliza. Good question. Prof. Loh, what question would you ask at AGM?
Yeah. Okay, maybe before I answer, Wan Chen, let me ask you one very short question. If you have a sustainability report, what is the first page you will turn to in the report? You are the professional here. What is the first page you will turn to?
I'll look at the material, the ESG factors section.
Oh, straight away go there?
Yeah.
But I think for me, if I look at the sustainability, the first page that I turn to is the table of contents. You know, right? Because I think a lot of people are doing sustainable report. They are missing the forest for the tree. So I want to see the big picture first, the narrative behind, the very purpose of their sustainable reporting. Instead of drilling deep into what is their carbon emission, how much waste they generate, what is the diversity ratio and all that. Look at the bigger picture, look at the narrative, look at the storyline. And then, you can really actually sniff out the authenticity of the report. Then after that, the next thing is to go into the core aspects like materiality. So the big picture is very important. And I think I know of people who read sustainability, they just flip the pages backwards, or they just look at the cover, it looks nice, always. I think about more than half of the sustainability report are green in color. I don't know why.
I wonder why.
Yeah, so I think that the narrative is very important. So it goes beyond the boilerplate. That template, the check the box approach must be avoided. Yeah, thanks.
What do you mean by check the box approach, Prof?
Oh, I think basically you just have a list of items and you just see whether you have fulfilled them. It's a very convenient way, a cop-out, way of trying to conform or comply. So you just have all a list of things and you just say, I've done this and this. Whether you are doing it mechanically or actually in essence, that's something very, very different. Or whether you are doing it or whether you actually even believe in it. It's not just obeying the letters, but actually going into the spirit of the whole compliance. That I think is the very, very core essence of what sustainability report is all about.
Yeah, good point, Prof. Yeah, I've seen a lot of sustainability reports. Like, for example, they adopt GRI as a framework.
Yeah.
So some of you investors may have heard of the term or seen it in your sustainability report, this thing called GRI. But how does GRI lead to the company making more money? That link, I don't see it a lot of time. And then you have people like Blackstone recommending SASB and TCFD. So how does all these acronyms link to strategy? How does it make showing you more money for the organization? So maybe over to you, Martin. What question would you ask at the AGM? And after that, we will go to, there's quite a few questions from the floor. So I will pose the questions from the floor to the panelists because we've got another half an hour to go and they're quite good few questions. So maybe Martin, from you, what would you ask if you're the retail investor at the AGM?
Yes, so nowadays, in most of the times, the management in their presentation is covering some of the ESG topics. And it's normally the ones where the company made some progress. So what I would ask is, where in the 17 SDG goals or in their ESG framework is room for improvement? And what are the action points of the company to improve exactly those points?
Just on that, should ESG or sustainability reporting be a standard board agenda item at board meetings?
So I sit on listed boards and I can assure you it is. And we manage quite a lot of money for the families. We sometimes have significant stakes in companies. And I give an example, we are a larger shareholder of a big hydro and fuel cell company listed in Germany. It's per se, obviously, a very E-compliant company. And there was a board decision. And there was no woman in the board so far. So we requested to do an intensive search and find potential candidates who are female, because we think the company did an excellent job in a lot of their criteria, but there are on the board, it was 3 very experienced old white men, and we requested to add a female. And I think, there is the investors really underestimate how much power they have. Every CEO finally, even in emerging markets, obviously in US and Europe already, they are a little bit more far ahead. But even in kind of in Asian boards, it's a big discussion nowadays, and everyone understood this is the main value driver. It makes my bank cheaper. It makes bond yield lower. Because if I click all the boxes, I get money cheaper. It makes my stock valuation higher. So this is the interesting kind of spin the whole thing got in the last 2-3 years. And that's why I'm so positive that it kind of is a self-fulfilling prophecy, because it's not from the regulator. It's not the MIS telling you you have to. No, it's your investor. It's your banker. And that is encouraging.
Thanks, Martin. So great question asked AGM. So ESG sustainability should be a board agenda item, should be asked at AGM. So maybe a related question that I'll ask the panelists, which is linked to one of the questions from the floor on the Chief Sustainability Officer. So a parallel question to that is that, should there be a board level sustainability committee? Should there be a board level sustainability committee? If sustainability is a standard board agenda item for every board meeting, and board meetings you have AC, RC, NC, Nomcom, Ramcom, Riskcom, Auditcom, should there be a sustainability com? And once you have a sustainability com, do we need a chief sustainability officer? And even without a sustainability com, do we really need a sustainability officer in the organization? So maybe I hear from the panelists. Should we have a sustainability committee at the board level?
I think it depends a little bit on the size of the company, but clearly for a multi-billion corporation with a bigger board, I think this is definitely the right way to go.
And maybe Martin can ask you, with or without a sustainability committee, does every company need a chief sustainability officer? Like what Prof. Low said, don't look for the CFO, look for the CSO. But if there's no CSO, what do you do?
Yeah, again, I think it depends a little bit on the size of the company. If you are a global multi-billion company, yes, I think you should have one, and most of them have already one. They might have not the specific title, but they definitely have someone in the senior management being responsible for it.
So, Prof. Low, if we want to look for the CSO and there's none, like what you say, don't look for the CFO, look for the CSO.
Yeah.
If there's no CSO, who is the default CSO? By default, is it the CEO?
No. If there's no CSO, don't buy the stock. No, I think having said that, but I think humor aside, you see, I think for a start, companies should have a dedicated mechanism to look at sustainability. I think a board level committee is overdue. Even some principal officer.
Let me pause you. So board level committee is overdue. So Prof, you are a strong proponent of that.
Yeah. But there's a second half of the story. Yeah. So at the start, I think all these are very necessary. But I think in steady state, sustainability should be so much part of the organization that it is not a separate vertical pillar. So it should be embedded throughout. So in a situation of normalcy, it should be done in such a way that it is, a habit of all departments to be sustainable. So I mean, the word of the sustainability is it should be well embedded throughout the whole organization. So I think, but before we reach that, we need this very committed and very pinpointed way to kickstart. Then eventually it should be embedded, internalized. I think in the literature we call it should be mainstream across the entire organization. Yeah.
So you feel that sustainability now is not mainstream enough. It's a appendage. It's a by the way for some organizations.
Yeah. There's no stream at all. Not even a live stream.
Not even a longkang.
Yeah.
Can I just chime in here?
Yeah, Eliza, please.
I just wanted to chime in here. So when we talk about whether there should be a separate board committee, we are really looking at the governance structure around sustainability issues. So we do note that for some companies, although they don't have a separate board committee, the sustainability agenda resides with the audit and risk committee. Yeah, so this is something that is taken care of. And when we look at governance, we should also be looking at the board's role in determination of these material ESG factors and the management strategy as well as approach in terms of managing all these material ESG factors. So even if a company doesn't have a dedicated board committee, maybe it's worthwhile looking at the mandate or the remits, right? Meaning the terms of reference for the audit and risk committee, whether sustainability is an item that resides with the audit and risk management committee.
That's a very good point, Eliza. I think that should be done. I think investors should ask the AGM for those companies without a board level sustainability committee to ask them where does sustainability fall into does it fall into the gap? Does it overlap? Does it fall into the lab of ACRC? Good point. So one of the questions asked by the floor is that, does Singapore have enough talent on sustainability? Sustainability is so important, not just talent at the CSO level, but how many at the board level truly understand things like culture? You know, when we say report on culture in the UK, in Singapore, you must have appropriate culture. You must have a culture of integrity, the purpose. It's such a nebulous and intangible topic. So maybe Martin, over to you. Do we have enough people at the board level? I mean, you're a board director.
I think, you know, Singapore has a uniqueness because it has good, very good local talent, and it combines it with good experts. This was always the way Singapore grew his expertise in certain areas. And I certainly think that there's enough talent in the city, and there's enough awareness in the city because, you know, Singapore is an island, water, food, there are topics and themes which are in everyone's mind and head, and everyone is aware, energy. So I think it will be easy for Singapore to implement that on a board level, on a company level. On the investor side, obviously, with limited amount of companies and sectors being listed on the SGX, it's not so easy. But having said that, even the REITs, even the real estate sector, as not kind of the darling of the ESG community, there's a lot of room for improvement. So, you know, there's two things of investing in that space. You can start from the exclusion side, you can do the ESG integration side, you can go towards impact and even draw it further towards philanthropy. But the biggest, from an investor perspective, to always buy the ESG darlings is sometimes expensive nowadays because the multiples of the ESG darlings are expensive. And the multiples of the ESG laggards, where if they do the right moves towards being more sustainable, those valuations are cheap, and there you might have, as an investor, a more impact. So it's, I think you can look across the whole chain, and I think, yes, Singapore is on the right path and has enough talent.
That's great. That's great. I think that will really augur well for our capital market. I think sustainability is going to be a springboard for the next lap for the capital market. Thanks, panelists. So let's go to the second question for the panel that I have. What are sustainability best practices? What do you think are the good things that people are doing? Prof. Loh talk about some of the not so good things like a boilerplate, tick the box, not mainstream, just a side stream, a longkang kind of thing. So these are the not so good things on sustainability report. So what are some of the good things that you think are best practices for sustainability reporting? And not just report. I mean, one of the questions on the floor is that the sustainability report is not audited. But I think from a audit point of view, there's an audit standard that requires auditors to look at the annual report. And if the sustainability report is part of the annual report, they are duty bound to review the entire report because it's what we call integrated. So the one is a related topic, but more importantly, maybe we can start with Eliza, then we go to Prof and then Martin. What are some of the best practices out there on sustainability reporting practices?
Yeah, so I will go along with what Prof. Loh mentioned earlier, telling a story. So our belief is that what we are seeing is that all our listed companies are already managing the ESG risk and opportunity. So it's a matter of them articulating in their annual report or the standalone sustainability report. What would come across as good practices would be not just a bed of roses, meaning that the report is being balanced. So there could be cases where the company had previously disclosed certain targets, but the company failed to meet those targets for the ESG factors. What we think would be useful for the investor would be the companies give a discussion as to why the target is not being met. What are the actions that the board has planned or the management has planned in order to meet the target? So I just wanted to also give my view on the report not being audited. So the observation is right. When SGX first mandated sustainability report for financial year ending on or after 31st December 2017, we recognized that some of the listed companies may be just starting out in their sustainability journey, and we did not mandate that companies will need to obtain independent assurance on their report. But rest assured that given the technology and also the social media, if they are false or misleading disclosure by the listed companies, and this come to our attention, if this is false and misleading disclosure by the company and the case has been made up, it would actually constitute a potential breach of the listing rules.
Are there any regimes which mandates sustainability report to be audited?
Not that I'm aware of. Maybe I can hear from the other panelists. But what we are seeing in the market is that the more mature reporters are getting their reports independently assured. It could be maybe the processes that have been put in place that are being assured, or the financial data that has been disclosed in the report that has been assured. So it could be different aspects of the reports being assured, but that is at the own discretion of the listed companies.
And some of them could be in certain industry which require those assurance.
Right, and it could be demanded by their stakeholders. For example, maybe their financial institutions who are relying on the report may want independent assurance to be provided on their sustainability disclosures.
Correct.
Yeah.
So to answer the question also for the person who asked the question about not being audited, I think retail investors need to go to AGMs and ask pertinent questions with regards to the sustainability report. Things like, why is it not audited, for example? Does it really add any value for it to be audited in the first place? Not just being audited for the sake of auditing. Thanks, Eliza. So, Prof. Loh, what are some of the best practices that you've seen with regards to sustainability reporting, besides a good story?
Yeah. Let me pick on the point of assurance as part of the best practice again. I think that if you set the issue in perspective, a sustainability report is not like a financial report. You just get one external auditor, they sign it on the bottom line, and presto, the whole report is okay. All the footnotes are fine, every item is fine. Whereas sustainability report is something that, it is a collection of many parts and pieces. And right now, I think the best practice is, I don't think you need a whole company to have every single item of the sustainability report assured. In fact, if you look at one company, let me just cite one random example. Let's say you look at City Development Limited.
Yep.
Of course, they have a good sustainability report. And you can see only some parts of the report are being assured. In fact, they have two assurers in the report. One is Register. The other one is, I think, EY. Yeah. and they focus very much on the environmental part, parts that are measurable, emission, waste management, all the quantifiable part. So the moral of story for good practice is that, you get only all those most critical part that needs to be validated, that needs to be verified. You don't have to actually do the entire report and get it assured, because first of all, it's almost impossible. Many of these are qualitative in nature. It's just like culture.
How do you assure culture? How do you assure
how do you assure culture? I mean, Wan Chen, if you can do it, you will be the first millionaire now. I mean, you're the first assurer of culture. I mean,
I'm still dreaming.
Yeah. So I think let's do some systematic bite size. Let's move incrementally. Best practices need not be imbibed all at once. Take bite size, and then let's move along the way and see what the stakeholder want. But the bottom line is, I think right now as a baseline, the environmental part has to be verified. I mean, you cannot just plug carbon emission from the air and say this is what we admit. I mean, that there are some systematic methodologies to do it. There's even external agency for you to submit your targets. For example, if you are doing SBTI, the Science-Based Target Initiative, you can actually submit your target and eventually get yourself, verified and, in terms of what you submit. Yeah. Okay.
Okay, let me go to one more final question for you, Prof, before I go over to Martin as to what's the best practices. So, Prof, you talk about the minimum baseline, you need to audit or provide assurance on environmental targets. Do you think there's an inordinate focus on the E as part of the ESG? I mean, everybody talk about climate change and environment, but we forget about other issues, which is the S and the G. So like culture, for example, is it because it's difficult to measure that people then shy away from it?
I think it is a combination of many factors. Right now, you're right. The attention is really on the E part. Even in the finance part, when we talk about green finance, the focus, which unfortunately is the case now, is to just look at environmental part. Although holistically, the social part integrates very well with the environmental part. So the green finance should actually embrace even the social and the governance part. So I think you're right. We have neglected the S part actually so much that it shows up in the pandemic. I mean, all the issues about labor relations, all the issue about workers' welfare. I mean, you don't have to go very far. You can see in our Singapore here. I mean, suddenly, in the last 1 year, we realized that, we need to do better to accommodate our, migrant workers, for example. So, yeah.
Yeah, cases like Top Glove in Malaysia, sacking the whistleblower. So how do we raise the eminence of the S? G is no problem. G, we're taking care of that. We've been doing G all this while.
Yes.
And E is really hot right now, climate change, TCFD.
Yes.
But how do we raise the profile of S?
S, yes. Yes. You have 2 S in your alphabets. Let's work together, NUS maybe together with SGX, and, Martin can join with your family office, representing investors. Let's work together to elevate S, go beyond the E. Yeah. G, I think, is quite taken care of.
Yeah, G is definitely, you're right. Because so you have SGX, you have NUS, CIAS, all the S's will come together.
Yeah. It needs, a certain concerted effort to really push it. And then let's mount some programs to do it. S is something that needs really to be taken care of. I mean, that is really the quality of society, quality of company. And I think inevitably we have to go into the culture part.
But I'm still waiting to measure culture, Prof. I'm waiting to be a
millionaire. PhD.
Martin, what are sustainability best practices? When you go out there and sniff out opportunities to invest, what are the best practices you look out for?
So first of all, let me come back perhaps what Prof just mentioned. Completely agreed. The E is the hot topic, and the investors are focusing on the G, pretty much taken care of. The S is difficult, okay? And you need, I think you need a very deep inside analysis into the company to really understand where on the S side they are lagging. So in general, you know, this sustainability and ESG being a development of the last couple of years is a pretty young practice, and there are no standards currently. And now, if you come from the investor side, we obviously cannot do kind of our own deep dive ESG in all companies. So what do? We rely on research companies who do this ESG research overlay on top of the normal fundamental analysis brokers and research houses do. And even there are perhaps a handful of top players nowadays, or a dozen of players nowadays. And then as investor, you can subscribe to those services and get their ESG ratings. But there as well, you know, for the same company with different ESG rating agencies, you get different outcomes. So it's not really standardized, which I think it is good, because it's young, it's developing, and at the end, like always, the investor is deciding, and you will then figure out which research house was correct, and which one has the emphasis on the wrong side. But I think it'll take some time. But it's not easy for an investor to navigate through all of that, but it's getting better, and there is more and more offerings, I think even for retail investors, on getting kind of a ESG rating, and not only for the professional investors who spend a lot of money on research.
Even for private companies, can you get ESG rating on private companies?
No, I don't think so. For private companies, it's good that you mention it, because in preparation for this panel here, I looked. We are quite active real estate investors as well all over the world, and for every investment now we do a ESG scorecard with an environmental part, emission, others, pollution, resource, water, energy use, innovation, adaptation, then a social part, and a governance part. And then we score all our investments. It doesn't matter if it's affordable housing or senior housing in the US, if it's student housing in Australia, we score. But we do that. We developed a framework, and our analysts and portfolio managers are, for the investment committee, are preparing that scorecard, and it's part of the investment decision.
And SGX has the book that guides you how to ask the right questions for sustainability reporting.
Yeah, I have to admit, I haven't looked at the SGX book. I think it depends a lot from industry to industry, you know, and you really have to, if you are an investor, you know, obviously if you're a solar investor, it's easier. If you're a cement factory, it's not so easy. If you're in the oil and gas business, it's quite challenging. But again, there you can move a lot. If you are the best practice oil and gas company, I think you can differentiate yourself with a tremendous higher multiple than the laggards in this area.
So Martin, if I can conclude, your view is that it's a growing field. There's still a lot of things to iron out. There's a lot of inconsistency between the rating agencies. How should investors navigate? When I wake up tomorrow morning, as I go to AGM and as I think about what to invest, what's the first thing that should come to my mind when it comes about sustainability?
Naya, I think
my North Star.
So first of all, as an investor, depending on your knowledge and know-how, you always have the choice to select a fund which does the job for you. If you have a little bit more knowledge, you can perhaps select a theme, an ETF. And if you're advanced, you can go into selecting single stocks and single bonds. So, and take a professional investor like us, even us. Yes, we have some singles down to the single stock investment in those areas, but there are other themes where we go with ETF or with fund managers. The only thing I can assure you is that from an investor perspective, it's fast growing, and it's faster growing than perhaps people thought. And now on the family office side, it's the patriarch who made the money, in all honesty, was not very ESG aware, okay? The way he ran the company, the way he built the business. Guess what? The next generation, educated at top universities, they have the luxury that the money was made. They are focusing much, much more on ESG. So the family's investment style completely shifts. And that is the money flow you actually then seeing on the exchanges, on the markets, into those stocks, into those bonds, into those ETFs, into those funds. And I think it just started. So we are only in the first inning, and it is definitely unstoppable. Now, in addition to that, now the fiscal side comes. So I think in Singapore it's the same, but it's in the US, in Europe, you have billions, trillions getting invested in ESG, especially on the climate, on the CO2 reduction, on the low carbon side, EV, electric vehicles. So I think it comes from both angles. It's the companies who are sustainable. They have strong growth via their business side, and they have investors investing into them and putting their stocks at high multiples, and so everyone benefits.
So the train has left the station, and investors need to get on.
I completely agreed. I think an investor who is, they should spend time to understand. There's tons of opportunities, and it's not only the darlings of the ESG. It's not only the solar company. Okay, it can be as well. Sometimes even more interesting. To take something like oil and gas, or something more on the carbon emission side, where today I had a meeting with one of the big shipping families. It's not a very kind of considered ESG friendly business, but this family has so much focus on being the best within the shipping industry, with lots of carbon offset investments and on the S side, on the G side. So, and I think it will help them to get better financing, cheaper financing, and have higher valuations for their stock.
Thanks, Martin. Well, we've got 5 more minutes left to this session. I need to pose Prof. Loh a question on culture. I can't help it. I need to hear from him. How do we measure culture? By just reading the annual report or just talking to the CEO. And after Prof. Loh has shown me the holy grail of measuring culture, then I'll pose the last question to the panel. Christmas has come early. What's your wish list for Santa Claus on sustainability reporting? So Prof, tell me the holy grail to culture measurement.
Okay. First of all, you're right. Looking at public information like annual report will not be sufficient to indicate culture. Although there are some clues about culture there. For example, you can look at the values, you can look at the code of conduct, you can look at all the narrative there, what they have done in, employee engagement, society engagement, leadership style. All these are telltale signs, but usually an annual report does not reflect culture. It reflects more the communication ability of the PR department. So yeah. So having said that, the right way to measure culture is actually to go down to the organization. I think it's not ideal, but that's the right way to do it. In scholarly term, we call it an ethnographic approach. Go down to get primary data. In fact, very interestingly, when culture was first tried to be measured in organization, they try to measure what they call the climate.
Oh,
but climate in the sense of organizational climate, not the physical climate, like the rain and the flood today. Yeah. So they actually look at things like, you know, some of the practices there in terms of climate, employee satisfaction, their you know, their welfare, leadership engagement, diversity. You know, all these are very, very holistic. And usually the scholars, researchers will go down to organization. The usual way is to give them questionnaire, which is what we call primary data. You collect the data not from secondary sources like annual report, but you get it from the horse's mouth itself. But that leads to another kind of issue, but that is at least as close as you can get. Short of, you know, inventing a technology called Internet of Things that can measure culture, the closest we can get is a questionnaire, primary data. Yeah.
Thanks, Prof. There's money to be made there, I think. So last question before we sign off. We got a couple minutes. So thank you, panel. Quick response from you. What's your Christmas wish for sustainability reporting for Singapore, for our capital market? Eliza, from you.
Thank you, Wan Chen. So I think Wan Chen mentioned about the boilerplate statements earlier because of the various reporting framework. So if my wish for Christmas will be there will be a standardized reporting framework, because we are hearing that investors and users of the sustainability reports are facing difficulties because of a different reporting frameworks. So it makes comparability between the sustainability data difficult. So the wish is for a standardized reporting framework.
BlackRock has already said TCFD and SASB is the way to go. So maybe that is an indicator. Thanks, Eliza. Great. Prof. Loh, what's your wish list? Christmas comes early.
I think I want a green Christmas approach, green color, green Christmas approach. First, you know, no real Christmas tree, but what it means for SRA is no printed SRA sustainable report. I still receive a lot of companies sending me real hard copy of sustainable report, you know, seriously, real hard copy in the snail mail. Companies send to me because I read all their sustainability. They think that sending me a hard copy will give them extra score. No. So I you know, they even send me plastic copy, you know, I have. And of course, I don't want turkeys for Christmas. So don't give me all the decoration. You know, this is carbon footprint. Don't give me turkey and aluminum foil, the packaging. I'm just looking for a real silent night approach towards sustainability, the quiet achiever. Do it online, do it real, do it authentic, a silent night approach. Yeah, thank you.
Thanks, Lawrence. Thanks, Prof. Loh, for that inspiring analogy. And Martin, over to you. What's your Christmas wish for sustainability for Singapore?
I completely agreed with Eliza that, you know, a globally unified standardized standard is needed and would be very helpful for investors. And I think an industry-specific approach as well, and not only for the listed, but also for the private segment.
Okay, thanks very much. Martin, Eliza, Lawrence, Prof. Loh, on a note, on behalf of SIAS, thank you very much for being on the panel this evening and sharing your thoughts and your insights as to how sustainability reporting has progressed in Singapore. As in Martin's words, it is still a growing field. There's lots of opportunities, but definitely there's money to be made for investors if they focus on ESG factors and sustainability reporting. And with that, I hand over back to the MC to close out this evening.
Thank you, panelists, Mr. Loh as well. We have come to the end of today's session. It has been a pleasure to have with us today. In case you missed any part of today's session, you will be able to rewatch the session on SIA's YouTube page. Do like our page and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a great evening ahead.
Thank you so much.
Thank you so much. Bye.
Thank you.
Thank you, everyone. Bye.
Yeah. Merry Christmas.
Happy Christmas.
A green Christmas. Yes,
6 months 9 months in advance. Yeah.
Thank you.
Bye-bye. Bye.